Good day friends and traders, my name is TIAN and I'm your host for today's UTP lesson on Fibonacci's, Fibs and Auto Fibs, and today is Monday the 20th of March 2017. Thank you everybody for joining. May I please confirm audio and visual? Do we have sound? Beautiful. Thank you KAW, thank you Robert, and thank you everybody else, Everett, KPH, Russell, thanks my friend. Right, I'm going to start with extensions and retracements in an uptrend, and I'm going to discuss the market retraces inside the AB boundary and how the market moves to the D extension, and then I'm also going to discuss drawing and adjusting uptrend lines. Right, now all movement is motion and energy. The deeper it goes, the less energy it has to bounce up. Fibonacci retracements and extensions, relationships in an uptrend. The deeper the market retraces, the less energy it has to rally. You can see here, if the market bounces at the 8.6 retracement level, it doesn't have enough energy to actually move all the way up to the 1.618. Therefore, the D extension is going to be the 1.18 extension. So let's start in the beginning. If you have an up AB boundary and the market retraces to the 382, then the D extension is going to be the 1.618. If the market retraces to the 50 retracement level, then the D extension will be the 1.618 as well. And if the market should retrace to the 618, then the D extension will be the 1.618. In the event that the market retraces to the 786, then the D extension will be the 127 extension, and in the event that the market should retrace to the 8.6 retracement level, the D extension will be the 1.18 extension. Also, if the market bounces off the A or very close to the A, then the D extension can either be the B high or the 1.18 extension. I still target the 1.18 extension, even if the market bounced against the A. Right, now there are no absolutes in the market. You cannot use the words always, every time, or never. The market will do what it wants to do. When it wants to do it, it will do it, and it will always be right, because the market is never wrong. There are primarily 6 different ways the market retraces back into the AB boundary. You have an AB boundary, the market will rally from the A to the B, and it will establish the AB boundary. Once the B high has been established, the market will start to retrace back inside the AB boundary, and this is what we know, this is what is known as a retracement. Right, is everybody with me up to this point? Just type a Y or a yes or a no, and then I'll explain it again. Okay, great. Just remember, if you have any questions, you're more than welcome to type it here in your question section box. Now there are predominantly 6 Fibonacci retracements in an uptrend. Here we have, let's just make that one a little bit bigger. Here's number 1, this is super shallow retracement. The market will establish the AB boundary and then give us a super shallow retracement where it might retrace to the 236 and then thereafter move all the way to the D extension. Then we have an example where the market will bounce at the 236 or give us a super shallow retracement where it didn't bounce at the 382, and then it's got a high majority chance of actually bouncing against the 127 extension, and then after it's bounced at the 127 extension, it will come down and either bounce against the 382 or just above the 50, and this is regarded as a shallow retracement, and then after that move towards the D extension. Also, it can give you a deep retracement, and a deep retracement is anything below the 50 retracement level. Anything below the 50 is regarded as a deep retracement. Then you also have a deep retracement where the market first bounces at the 382 but starts to wave down deeper inside the AB boundary, and it could actually move as low as the 786 or the 86 retracement. That's why it's so important to confirm the bounce or confirm the C with a counter trend line break. You have to make absolutely sure that the market has established the C, and the only way to do that is to draw in a counter trend line to confirm that the market is indeed moving from the C to the D. Then you also have another way that the market can actually move inside the AB boundary, and this is what we refer to as a whippy nasty lashy movement, where it's just extremely volatile as it retraces to the C, and then it continues being volatile all the way from the C to the D. Right, now there are primarily 6 different ways the market moves from the C to the D extension. There's your AB boundary. The market establishes the AB boundary, then it retraces to establish the C, and then when you have a confirmed C and you are moving from the C to the D, this is what we call an extension. Right, now have a look at this. There you have an up AB boundary, and the market retraces to the 382, and then the D extension will be the 1.618, right? But before that, the market actually gave you a super shallow retracement, and that's why it bounced against the 127 extension. Right, to give you an example, we actually have an example. It's on the dollar CAD. Let's see. There we go. There's a down AB boundary. Can everybody see this chart? With the down AB boundary over here, there's the A, there's the B, right? And the market moved down, it established the AB boundary from the A to the B, AB boundary. Then it retraced, but didn't even bounce against the 382. So that was a super shallow retracement. And that's why the market went down, took out the B low, but bounced against the 127 extension. Now all of a sudden, the 127 extension becomes a major level of support. That's why the market bounced against the 127 extension. Then the market started to retrace back inside the AB boundary after it bounced against the 127 extension, and has now moved all the way to the 618. We actually got a 618 retracement here. There we go. Bounced at the 618. And that is the C for a nice deep C. And now we are moving from the C to the D. Right, we are moving from the C to the D. And the D extension is going to be the 1.618 over here. There, that will be the D. Over there. And now we are moving from the C to the D again. Okay, but what I want to point out here is that, can you see, after we got a super shallow retracement, the market bounced at the 127 extension, and then after that gave us a deeper retracement. Okay, are we all on the same page? Let me know that you can see that the market will most probably bounce against the 127 extension if you have a shallow or a super shallow retracement. Right. You also have an example where the market would retrace deep inside the AB boundary, bounce at the 618, and then head to the D extension. Or it might bounce at the 618 and actually then bounce against the 127 extension, retrace a little bit before it goes up. But in the event that the market gave you a deep retracement and it bounces against the 127 extension, then you need to look left and look at previous market movement, because that 127 extension might form a confluence with a pivot, and that's why the market bounced against the 127 extension. Also, the market may move from the C to the D and actually bounce against the 127 extension and then come down, and then from there go up to the D, or it might just wave up to the D extension or turn whippy lashy and nasty. But the most important thing you need to ask yourself in the morning when you open up your chart is the market moving from the C to the D, or is the market moving from the B to the C? Okay, and that will determine your direction of highest probability. That will give you the direction for the day. The average distance between a C to a D in an uptrend or a downtrend on various time frames. On a 15-minute chart, it's around about 45 pips. On a 30-minute chart, it's about 90 pips. On a 60-minute chart, it's about 180 pips. On a 2-hour chart, it's 240 pips. On a 4-hour chart, it's 300 pips. On an 8-hour chart, it's 420 pips. On a daily chart, it's 600 pips. On a weekly chart, it's 1,500 pips. And on a monthly chart, it's 2,400. The distances between the C to the D will depend on average daily trading ranges. The smaller the daily trading range, the smaller the distance between the C to the D. The larger the daily trading range, the larger the distance between the C to the D. These numbers are estimates for example purposes, and actual numbers may vary because of the daily trading ranges. For instance, if you have a look at the euro pound, it's got a very low daily trading range. Currently it's about 60 pips. But if you have a look at some of the more volatile pairs, like the pound yen and the pound Swiss and the pound Aussie, that daily trading range can be in excess of 200 pips. All right. Auto up ABCDs. Now this is how you're going to draw your fibs using the auto fib tool. Compress the chart. Find the lowest low in the chart, which will be the beginning of the new uptrend. Click the auto up ABCD tool on that low. If a green and yellow box appears at the current market, the market is in an uptrend. If it doesn't, the current market is in a downtrend, making lower lows, and you will need to find the high of the reversal and click on the high to identify the new downtrend. So the very first thing you need to do is just compress your chart. And let's use this one as an example. Right? Compress the chart. We can see here, clearly we can see here, that we had an uptrend there. But that uptrend was broken to the downside. And we can see that the market is crowning over here. Here's a left tip, center tip, and there's a right tip, and there's our crown. So clearly the trend has changed from bullish to bearish. The trend is now changing. So I am not going to start my Fibonacci's at this absolute low on the chart because it doesn't reflect the most current trend. Instead, I am going to start my Fibonacci's at this high of the chart because that will reflect the most current trend. Does that make sense? This is how you do your fibs. This is how you establish the spot where you want to start your Fibonacci's. Compress the chart and identify the most current trend. Look at the previous trend and then just make sure that the previous trend is either intact or the market has broken it. If the market has broken it, you have a new trend, and then start your Fibonacci's accordingly. Okay, good stuff, good stuff. Thank you, everybody. Auto down ABCDs. Compress the chart, find the highest high in the chart, which will be the beginning of the new downtrend. Click the auto down ABCD tool on that high. If a red and a yellow box appears at the current market, the market's in a downtrend. If it doesn't, the current market's in an uptrend, making higher highs, and you'll need to find the low of the reversal and then click on the low to identify the new uptrend. Right, there you can see the market broke a previous uptrend, now the market's moving down. So now you have a down AB boundary. Now we get to drawing uptrend lines. Now there are primarily 3 uptrend lines formed in an uptrend. An inner trend line, an outer trend line, a long-term trend line. Draw uptrend lines across the lows of the support connecting the A's and the C's after a new high has been made. Draw uptrend lines across the lows of support connecting A's and C's after a new high has been made. The long-term trend line is drawn after compressing the chart and connecting the first A or lowest low with the next higher low. The outer trend line is drawn starting with the previous low above the long-term trend line, moving it forward till the line hits the next low. An inner trend line is drawn starting with the previous low above the outer trend line, moving it forward till the line hits the next low and or connecting the most recent A and C. To give you an example, heading back to the dollar CAD, but maybe a higher time frame. There's the monthly. Look at that. Clearly we can see the market broke the previous downtrend, right? So now the trend is bullish. We don't have a bear trend anymore. We have a bull trend. So now what I'm going to do is I'm going to connect these first two lows, and those will be called the lower significant turning point, because I have two higher lows after the market violated or breached the previous downtrend. So this will be the outer trend line, or the long-term trend actually. There we go, that will be the long-term trend. Then we have an outer trend over there, so that will be the outer trend. And this will be the inner trend. There we go. Right. You can even have a more aggressive inner trend line there. There is nothing wrong if you have two inner trend lines. This might be referred to as an outer trend line as well. And that will be the inner trend. So now we can see that the market broke the inner trend, or the inner trend line, and now it's heading towards the outer trend line. So it will most probably wave down towards the outer trend line and then bounce. If it doesn't bounce and it breaks, then it will move towards the next trend line and the next trend line and the next trend line. Everett says, can you go over that portion again, please? Yes, Everett, what is there that you don't understand? Just let me know. Here's another example, right? Let's just have a look at this again. Draw uptrend lines across the lows of support, connecting A's and C's after a new high has been made. So there's an A. Let's use this. A, B, C, right? And then the D extension will be somewhere over there. So now you connect the A and the C, or just the next two higher lows, and that will give you your long-term trend. Everett says, is this current live dollar CAD chart? Yes, it is. This is a monthly chart. This is a monthly chart. So we can see that the market broke the inner trend line, so it will most probably head to that outer trend line over there. Okay, so in my opinion, there's downside potential all the way to that outer trend line for the next 1,000 pips. And I will start my Fibonacci's right at that high over there, and there's the down AB boundary, because we're heading towards the outer trend line. Okay, that will actually be a down sub AB boundary, because the capital up AB boundary will be drawn where the whole trend changed over here. Okay, but I'm not too concerned about it because we're seeing a deep retracement and the market broke the inner trend line. So not too concerned about it. Does that make sense? Okay, no problem there, Everett. If there's still anything you don't understand, just let me know and just type it here in the question section box. Also, if there's a currency pair that you're looking at and you want me to just have a look at that to see if you've drawn it at the right spot, you're also more than welcome to just type it there in the question box. Right, first step to finding and drawing correct uptrend lines is to first compress your charts and find a trend reversal where the market has broken a downtrend line and is now making higher highs and higher lows, just like I explained. First step to finding and drawing correct uptrend lines is to first compress your charts and find a trend reversal where the market has broken a downtrend line and is now making higher highs and higher lows. So there we can see the market broke a downtrend line and now it's making higher highs and higher lows. So that is the new uptrend line, and this lowest low over here, which I refer to as the lowest significant turning point, that will be the starting point of your Fibonacci's. Trend lines. Draw uptrend lines across the lows of support connecting A's and C's after a new high has been made. The long-term trend line is drawn after compressing the chart and connecting the first A or lowest low with the next low that hits the uptrend line. The outer uptrend line is drawn starting with the previous low above the long-term trend line, moving it forward until the line hits the next low. An inner trend line is drawn starting with the previous low above the outer trend line, moving it forward until the line hits the next low and or connecting the most recent A and C. So there's your long-term outer trend line, there's your outer trend line, and there's your inner trend line. If the market breaks the inner trend line, it will move towards the outer trend line. If the market breaks the outer trend line, it will move towards the long-term outer trend line. Okay, now we get to extensions and retracements in a downtrend. The market retraces inside the AB boundary. I'll also discuss the market moves to the D extension and then drawing down trend lines. Now there's a phenomenon in the market. As the market moves down, it moves in the same numerical sequence as an uptrend but in the opposite direction. Fibonacci retracements and extensions, relationships in a downtrend. The deeper the market retraces, the less energy it has to rally. So there we have a down AB boundary. The market retraced to the 382. It's got a lot of energy to actually rally towards the 1.618. Also, if the market should retrace to the 50 retracement level, the D extension will be the 1.618. And if the market should retrace to the 618, then the D extension will be the 1.618. In the event that the market should retrace to the 786, then the D extension will be the 127 extension. And if the market should retrace to the 86 retracement level, then the D extension will be the 1.18. Also, if the market moves beyond the 86 or above the 86 and but doesn't take out the A, it's still regarded as an 86 retracement level, and the D extension will still be the 1.18. Now there are primarily 6 different ways the market retraces back into the AB boundary. There's the down AB boundary from the A to the B, and then it will retrace to give you a higher or a lower high, which is the C, and once the market reaches a counter trend line, it will move from the C to the D. But what I'm going to discuss now is the retracement from the B to the C, back inside the AB boundary. Right, now there are 6 Fibonacci retracements in a downtrend. The market will retrace from the B to a shallow C, or a super shallow C where it didn't hit the 382. Also, it will give you a shallow retracement, then bounce against the 127 extension, and then give you a deeper C. Right, like I just explained on the dollar Canadian earlier, where the market took out the B low but then bounced against the 127 extension, and now we're going to see a deeper C. This is what I'm waiting for in the Euro Aussie as well. To give you an example, there's the down AB boundary. Now look at this. A, B, super shallow C. There. The market did not hit the 382. So that is a super shallow C. And then the market moved down and bounced at the 127 extension to the pip. Bounced at the 127 extension. And now it is retracing back inside the AB boundary. potentially all the way to the 382 where I'll stop buying. And then we'll see a deeper C, and then we're going to move from that C all the way to the D extension. Okay. Does that make sense? Is everybody with me up to this point? Okay, beautiful. Beautiful, beautiful, beautiful. Right. Also, the market will retrace to the 86 and then it will move towards the 1.18, or it will just retrace to to give you a deep retracement past the 50. You can also have a deep retracement where the market would bounce against the 382 but not take out the B low and give you a deeper retracement. It might wave up to give you a deeper C, or it might turn whippy, nasty, lashy. Now, there are primarily 6 different ways the market moves to the D extension. If you have a down AB boundary and you did get a deep C and you have confirmed that the market is indeed moving from the C to the D, this is how the market will move from the C to the D. As the market dips, creating a down ABCD price swing, it has 3 hidden natural levels of support. So you have your A, B, C, and now the market is moving from a C to the D. It will have support at the B low. It will have natural support at the 127 extension, but only if it forms a confluence with a Fibonacci level. Okay, and then also the market will then find support at the relevant D extension. To give you an example of why the market could bounce against the 127 is because it might form a confluence with a pivot. And we can see here on the Euro Aussie that 127 extension actually also formed a confluence with a pivot where the market reacted in the past. So that's why the market bounced over here. To give you another example, the pound New Zealand dollar on the daily. We have a very interesting scenario here where we have a pivot at around about 7 figure over there. Seven figure. So that's a pivot, support, support, support again, and then it became resistance, and now it's resistance again. Okay, and if you have a look at the Fibonacci's over here, there's a down AB boundary, and that 1.77 figure forms a confluence with a 127 extension. So the market came down, established the AB boundary, then gave a super shallow retracement, and that's why it bounced against the 127 extension. But what I'm trying to say is, if the market gave you a deep retracement and it bounces against the 127 extension, then you're going to have to look back and see, but hey, wait a minute, is that a pivot? Does it form a confluence with a pivot? Because you can see here in the past that the market bounced at 1.77 figure. Okay. Just keep an eye on that. Right. As the market dips, creating a down ABCD, it has 3 hidden natural levels of support. Here you have a down AB boundary. The market bounced against the 382. Now, if the market doesn't give you a deep retracement, it's bound to find support at the 127 extension. It could even come back and give you a deeper retracement. Right, now there are 6 different ways the market can move to the Fibonacci extension in a downtrend. There you have your down AB boundary and super shallow retracement. Market bounces against the 127 extension, then gives you a deeper C and then move to the D, or it might just give you a deep C and then move to the D. It might give you a a deep C bounce against the 127 extension, then retrace, but it's basically just waving down. Here also, number 4, you have the market waving down, also bouncing at the 127 extension and then retracing and then coming down again, or it can just wave in such a way where it doesn't bounce against the 127 extension. So personally, if I open up the charts and I see a down AB boundary with a deep retracement, I'm not going to regard that 127 extension as a significant level of support unless it forms a confluence with a pivot. All right. And then also the market can turn whippy, nasty, lashy inside the AB boundary. Downtrend lines, drawing downtrend lines. There are primarily 3 downtrend lines formed in a downtrend. You have an inner trend line, an outer trend line, and then a long-term trend line. Draw downtrend lines across the highs of resistance, connecting A's and C's after a new low has been made. So there we go. Just imagine you now had an uptrend here and the market changed direction, and that very first new down AB CD, that will establish your long-term trend, and as the market moves lower you can draw more aggressive downtrend lines. So the next one will be the outer trend line, and then you'll get the inner trend line. Draw downtrend lines across the highs of resistance, connecting A's and C's after a new low has been made. A long-term trend line is drawn after compressing the chart and connecting the first A or highest high with the next lower high. The outer trend line is drawn starting with the previous high below the long-term trend line, moving it forward till the line hits the next high. An inner trend line is drawn starting with the previous high below the outer trend line, moving it forward till the line hits the next high and or connecting the most recent A and C. First step to finding and drawing correct downtrend lines is to first compress your charts and find a trend reversal where the market has broken an uptrend line and is now making lower lows and lower highs. Here's an example. Let's open up the pound Aussie. There we go. We had an uptrend. There's the uptrend. Market broke the uptrend. Now we're heading down. So now we have an outer trend line over there, and we have an inner trend line over here. There we go. So now the market has broken the inner trend line and it's heading towards the outer trend line. Now we do have a down capital AB boundary. There we go. But I'm not too concerned about it due to the fact that the market is moving towards the outer trend line. So I'd rather focus on this one over here, the up sub AB boundary. Now we're going to wave up. Now we're going to wave up all the way. There's the A, B, C. Then we'll go up and hit the D, and then we're going to have a new up AB boundary all the way to the outer trend line, and then we're going to bounce and come down and see a deeper retracement. Okay, does that make sense? Are we all on the same page here? Okay, good. Thanks, Robert, Everett, Stanley. Thank you, Stanley. I got your email. I replied to your email there. I just need to wrap my head around the algebra part, and then I'll get back to you. Right, now the first step to finding and drawing correct downtrend lines is to first compress your charts and find a trend reversal where the market has broken an uptrend line and is now making lower lows and lower highs. The highest high is the starting point, and then you just draw your downtrend lines here, and you'll get to your outer trend or your long-term trend, and then your outer trend, and then your inner trend. So there's the long-term outer, there's the outer, and there's the inner. Draw downtrend lines across the highs of resistance, connecting A's and C's after a new low has been made. The long-term trend line is drawn after compressing the chart and connecting the first A or highest high with the high that hits the line. The outer downtrend line is drawn starting with the previous high below the long-term trend line. So it's below the long-term trend line and moving it forward until the line hits the next low. An inner downtrend line is drawn starting with the previous high below the outer trend line, moving it forward till the line hits the next high and or connecting the most recent A and C. Okay, so that's how you draw trend lines. That's how you draw your Fibonacci's. At the highest or lowest significant turning point, you start your Fibonacci's. However, if the market has broken an inner trend line and it is retracing, focus on the sub-up AB boundary. Okay, because now you are moving towards the other trend line. Okay. Any questions? Any questions? I hope you guys enjoyed the lesson. Robert is asking, when do you focus on an up sub? I'm going to start a new chart here. If the market is moving down, if you have an outer trend and an inner trend like that, so that's the outer trend. And that's the inner trend, right? This is the inner trend line. As soon as the market breaks that inner trend line, like that, as soon as it breaks it, then you will draw an up sub AB boundary, because now the market is headed towards the outer trend line. Even though you still have down capital ABCDs, even though you still have a down capital AB boundary. As soon as the market breaks that inner trend line, then I am not focusing on the down capital AB boundary until the market hits the outer trend line. And as soon as the market hits the outer trend line, starts moving down, then the down capital AB boundary comes into focus again. Does that make sense? Okay, beautiful, beautiful. So it's reliant on your trend lines. Your trend lines form a significant part of the thinking behind the Fibonacci's and on which Fibonacci's you are actually going to focus. Are you going to focus on the capital or the sub? Well, you need to look at your trend lines. Where are those heading? Okay. Right, guys, this is the end of our lesson. I thank you so much for your wonderful participation. Thank you for your questions. Robert is asking, is that called a Gartley? Well, if you have your sub D extension forming a confluence with a 618 or the 786 of the capital, then yes, that's a Gartley. Everett says, I tried drawing the fibs on the euro dollar daily. I have the trend lines, but I got mixed up. I was seeing what appeared to be trend reversals. The market was taking out the A. Everett, I'll have a look at that back in the Analyst on Demand, because unfortunately we've now run out of time. but to give you a hint, look at the market, open up a weekly or a daily chart and compress it, and just look at the past 2 years, and then you'll see that the market had no trend and it was actually consolidating. Okay, have a look at that, and that will make more sense. Okay, but I'll see you guys back in the Analyst on Demand. Thank you so much for your participation. I'm going to take a 15-minute break, and then I'll start the AOD again. Okay, thank you very much. I'll see you in a jiffy. Cheers.